To understand what really just happened between the United States and Canada, you have to stop watching the podiums and start paying attention to what's happening beneath your feet. Because the real story isn't in the press conference, it's in the ground, it's in the mines, it's in the rail cars, it's in the invisible inputs that make modern life work and what happens when politics decides to play chicken with them. If you've been following the headlines, you've probably heard the usual soundtrack. Tariffs, retaliation, tough talk. We'll make them pay. We have leverage. We're defending our workers. And if all you do is watch the speeches, it can feel like a simple contest of willpower. One side threatens, the other side blinks. But markets don't care about posture. Markets care about exposure. And the moment these tariff threats hit the air, the market reaction told you the truth. This wasn't a display of strength. It was an X-ray revealing vulnerability. So let's slow down and walk through what actually happened, why it happened, who got hurt first, and why the damage didn't require a single tariff to be collected. Now, before we go deeper, do the usual things. Subscribe, comment where you're watching from, and hit like so this reaches the people who are living inside the consequences without even knowing the mechanics. Because if you understand the mechanics, you stop being fooled by the theatre. Here's the key. The administration's threats targeted Canadian potash. Most people heard potash and mentally filed it under some commodity, something negotiable, something you can substitute, something you can source elsewhere if the price rises. That assumption is the entire mistake. Potash isn't a luxury product. It isn't a gadget. It isn't a nice-to-have input you can skip this season and buy next year when things calm down. Potash is potassium, and potassium is not optional. It is one of the core nutrients plants require to grow. Not for maximum yield, for basic survival. Potassium helps plants regulate water, resist disease, and build the internal processes that turn sunlight into usable energy. You can't innovate your way out of potassium deficiency with a clever tweet. You can't replace it with patriotism. If your soil doesn't have enough potassium and you don't add it, your yields collapse. And in a modern agricultural system, one built on high output and thin margins, yield collapse isn't a philosophical problem. It's a bankruptcy problem. It's a food price problem. It's a political stability problem. So now ask the next question. Where does the United States actually get potash? This is where the story stops being a debate and becomes a dependency. The US relies on Canada for the overwhelming majority of its potash imports. Roughly the high 80% in many recent estimates, depending on the year and category you measure. That is not a balanced relationship. That's not we can switch suppliers if we need to. That's a single point of failure. And it's not a single point of failure you can fix quickly, because potash isn't produced by snapping your fingers and opening a warehouse. It comes out of deep underground mining systems that take years to build and billions of dollars to expand. Even if the US decided today to become self-sufficient, the timeline would collide with reality. Permitting, geology, infrastructure, capital cycles, labor, equipment, environmental constraints. This isn't software. You can't patch it next week. So when a political administration threatens tariffs on Canadian potash, what they are really doing is threatening to raise the cost of a vital input that the domestic system cannot replace. And here's the part that mainstream commentary often misses. The economic damage doesn't start when the tariff is signed. It starts when the threat becomes credible. Because the moment the threat enters the system, every participant has to reprice risk. Distributors start thinking about supply interruptions. Buyers start thinking about rushing orders. Sellers start thinking about how much leverage they now have. Traders start thinking about volatility, and volatility is profit, if you're positioned correctly. So the market moves first. Prices jump not because potash suddenly vanished from the earth, but because uncertainty was injected into a rigid supply chain. Rigid is the key word. Potash supply is rigid in the short run. If the world wants more potash tomorrow, you cannot magically mine more tomorrow. The system is built for efficiency, not elasticity. It is optimized to run steadily, not to respond smoothly to political shocks. When you inject a shock into a rigid system, you don't get a gentle adjustment. You get a spike. And that spike hits the people with the least ability to avoid it. Not the politicians, not the commentators, not the people shouting strength into cameras. The farmer. The farmer in Iowa or Illinois or Kansas doesn't get to rewrite global commodity pricing. The farmer doesn't get to call their customers and say, "Hey, corn is now 12% more expensive because my fertilizer input just got hit by political turbulence." That's not how markets work. Farmers are price takers on the output side, but they're forced buyers on the input side, which means when input costs surge, they eat it, they absorb it, they borrow more, they cut somewhere else, they push closer to insolvency. And in many cases, they have no cushion because modern farming is a capital-heavy business built on debt cycles and seasonal risk. That's why threatening potash isn't tough negotiating. It's pointing at your own agricultural base and saying, "We're willing to make your operating costs jump dramatically because we want leverage somewhere else." That is not leverage, that is self-harm disguised as leverage. Now zoom out further because this is where the phrase "beneath our feet" becomes literal. Canada doesn't dominate potash because of clever diplomacy. Canada dominates potash because of geology. The world's most important potash deposits, especially the massive, high-quality reserves in Saskatchewan, are not a political opinion. They are a physical fact. You can't sanction a mineral deposit into moving across the border. You can't negotiate with the periodic table. You can't threaten the earth into rearranging itself. So in the potash relationship, Canada holds a kind of power that's more durable than political power, structural power. Structural power means you control something essential, and others cannot easily replace you. That's why in episodes like this, the loudest side often isn't the strongest side. Sometimes the loudest side is the most exposed side. And Canada understood that. They didn't need to scream back. They didn't need to match rhetoric with rhetoric. When you hold structural leverage, you don't need a spectacle. The market becomes your megaphone. And the market's message was simple. If you destabilize the potash supply line, you destabilize American agriculture. If you destabilize American agriculture, you destabilize food prices. And if you destabilize food prices, you destabilize the political core. That's why this episode matters far beyond fertilizer. It's a case study in how the modern economy punishes governments that confuse intimidation with strategy. Threats are not a substitute for planning. Noise is not a substitute for supply. And if you want to understand what comes next, who benefited from the chaos, why volatility is a business model for certain players, and how this kind of policy becomes a wealth transfer from the real economy to the speculative economy, then in part 2, we have to follow the money. Because the most important question isn't who won the argument, it's who got paid the moment the argument started. Now let's follow the money, because once you do, the whole story flips. When a government threatens tariffs on a critical input like potash, most people imagine a simple cartoon. We tax them, they pay, we win. It sounds like a bill sent to Ottawa, like Canada writes a check to the US Treasury and Americans celebrate. That is not how it works. Tariffs are paid by the importer, meaning the first people who pay are American businesses buying the potash. Then those costs move down the chain until they land on the person with the least ability to resist. In this case, the farmer. So when politicians sell you strength, what they're often really selling is a mechanism for cost transfer, one that starts at the top as rhetoric and ends at the bottom as real pain. But here's the more perverse part. The tariff didn't even need to be implemented to trigger that pain. Because what the market traded wasn't the tariff. The market traded the risk of the tariff. And risk is a commodity. In modern finance, uncertainty isn't just a side effect. It's a product. Volatility is a product. Fear is a product. And there are entire institutions, trading houses, hedge funds, commodity desks, built to profit when that product gets injected into the system. Think about what happens the moment a tariff threat becomes credible. Distributors and fertilizer companies start asking, do we front-load orders now before the policy hits? Do we increase inventory? Do we hedge? Farmers start asking, do I buy now at a higher price or gamble that it comes down? If I wait and it spikes again, I could be ruined. Speculators start asking, how big will the price move be? How fast? What's the narrative? Where's the liquidity? And once that starts, it becomes self-reinforcing. People rush to protect themselves, and that rush itself pushes prices higher. This is not because potash suddenly disappeared. It's because political behavior created a panic premium, a risk premium, a tax on stability. So who benefits? First, anyone holding potash inventory. If you already control stock, if you're a producer, a distributor, or a trader sitting on supply, you just watch the value of what you own rise instantly. On paper, your balance sheet improved because politicians threatened a supply line. That's the perverse outcome. The punished supplier can actually gain pricing power in the chaos. Second, traders who thrive on violent movement. Stability is bad for speculators. If prices are predictable, it's hard to make extraordinary profits quickly. But if a government tosses a hand grenade into a tight market, you get the one thing traders want more than anything: volatility. Volatility creates opportunity. Spreads widen. Options reprice. Futures jump. Margin calls happen. People get forced to buy high or sell low, and the institutions positioned correctly make money from the turbulence itself. Meanwhile, the productive economy, the part that grows food, builds things, employs people, gets punished for being real, because real businesses need predictability. A farm doesn't run on headlines. A farm runs on schedules, budgets, seasons, and biology. You can't pause a growing cycle because Washington decided to start a fight. And this is where the potash case becomes a perfect example of inelastic demand. Inelastic demand means you need it even when the price rises. If a vacation becomes expensive, you don't go. If a new phone becomes expensive, you wait. If fertilizer becomes expensive, you still have to buy it or you risk losing your entire crop. And that means the seller has leverage. The trader knows the buyer is trapped. Everyone in the chain understands that if prices spike, the farmer can't just walk away. So when you hear tariff threat, translate it into plain English. It means you just handed leverage to sellers and traders, and you forced domestic farmers into a position where they must pay whatever the market demands. Now let's talk about who pays, because it's not just the farmer. Farmers operate on razor-thin margins. Most of them finance their season. They borrow in spring to buy seed, fuel, labor, fertilizer. They hope that in fall the harvest pays off the loan and leaves a small margin to live on. That means they're already carrying risk. And when input costs rise suddenly, 20%, 30%, sometimes even more depending on the product mix, it can wipe out the margin entirely. It can turn a stable operation into a crisis. So what happens next? They cut spending. They delay equipment upgrades, they reduce hiring, they scale back purchases in local towns. That's how an input shock becomes a rural recession. It doesn't just hurt one farmer, it hurts the entire network around agriculture. Truck dealers, mechanics, grain elevators, suppliers, restaurants, small businesses in farm communities. And then, because agriculture is the first link in the food chain, the cost pressure eventually leaks into grocery prices. Not instantly, but steadily. Fertilizer costs affect planting decisions. Planting decisions affect yields. Yields affect supply. Supply affects food prices. So when politicians create potash volatility, they are not punishing Canada. They are planting the seeds of higher food prices at home, which leads to the big structural point. This wasn't just a policy mistake. It was a demonstration to the world that the US political system is willing to weaponize essential supply chains without understanding the consequences. And credibility is a currency. When a government behaves unpredictably, every counterparty adds a premium for risk. Businesses hedge more. Investors demand higher returns. Companies hold more cash instead of building factories. The economy slows because everyone is defending themselves. This is how political volatility becomes economic drag. And Canada's response, the calmness, wasn't politeness, it was structural confidence. Because Canada knows the hard truth, in potash, the US is not the dominant player. The US is the dependent buyer. So the tough talk was never scary to Canada. What it did was scare American farmers, scare distributors, and excite speculators. Which brings us to the most uncomfortable question. Was this ignorance, or was the chaos the point? Because sometimes the spectacle exists not to solve a problem, but to create an illusion of action, to look strong on television, to feed a narrative. But in economics, action always has reaction, And the reaction here was immediate. A wealth transfer from the productive economy to the speculative economy, from the heartland to the trading desk, from people who grow food to people who trade fear. And in part 3, we're going to go even deeper, because this potash episode is not isolated. It's a template. The same structural vulnerability exists in other critical inputs: energy, semiconductors, rare earths, industrial metals. And once you see the template, you realize something chilling. The biggest risk to national strength isn't foreign enemies. It's leaders who confuse performance with strategy and accidentally expose the country's jugular on live television. Now zoom out, because if you treat the potash episode as a one-off mistake, you miss the bigger warning. What happened here is not just about fertilizer. It's about a pattern of governance that mistakes noise for power and emotion for strategy. And that pattern becomes dangerous the moment it touches essential inputs. The things you can't substitute, can't delay, and can't patriotism your way around. Potash is one of those inputs, but it's not the only one. In the 21st century, national strength isn't just measured by GDP or aircraft carriers, it's measured by supply chains, by whether you control the arteries that feed your economy. Energy, fertilizer, chips, industrial metals, shipping lanes, rail networks, refining capacity. These aren't background details. They are the physical platform that makes the modern state function. And the potash crisis exposed a brutal reality. You can have the loudest megaphone in the world and still be dependent on someone else's geology. That's why this case matters. It revealed a structural vulnerability that doesn't go away when the news cycle moves on, because after the cameras leave, the dependency remains. The US is still not self-sufficient in potash. The US still relies on Canadian supply. And the market now knows with greater confidence that this supply line can be shaken by political impulse. That knowledge changes behavior. It changes how companies hedge. It changes how farmers plan. It changes how investors price agricultural risk. It changes how Canada thinks about its own leverage. And here's where the story gets even more serious. Once a partner realizes you're willing to weaponize interdependence recklessly, they start preparing for a world where they can't rely on you either. So Canada doesn't just wait. Canada adapts. They deepen relationships elsewhere. They diversify export destinations. They build infrastructure to serve other markets. They invest in domestic processing and downstream value. They quietly reduce exposure to American political volatility. Because if your partner is unpredictable, you don't keep your entire future chained to their mood swings. And this is the real long-term cost of economic bullying. It pushes allies to behave like neutral states. It turns stable partnerships into risk management exercises. It fractures trust. And trust, again, is a currency. Now some people will respond, fine, then the US should just mine more potash. But remember what we said in part 1. This is not just a matter of desire. It's time. It's capital. It's permitting. It's infrastructure. It's the long, slow grind of the physical world. A mine is not a speech. A mine is not a policy memo. A mine is not a campaign slogan. A mine is years of engineering, billions of dollars, and a regulatory process that cannot be rushed without consequences. Which means the short-term reality is unavoidable. If you destabilize Canadian potash flows, you destabilize American food production costs. And if you destabilize food production costs, you destabilize the very thing governments fear most: public anger over the cost of living. So why would leaders even touch this? Here's the uncomfortable answer. Because political incentives reward performance. A tariff threat is visible. A supply chain strategy is invisible. A threat gets headlines. A long-term industrial plan gets ignored. And modern politics is addicted to short-term visibility. That's how you get policies that make no sense economically, but make perfect sense politically, because they create the appearance of action. But economics doesn't care about appearances. Economics cares about constraints. So what's the constraint here? Is that North America is integrated by design. For decades, US-Canada trade has been built to lower costs and increase efficiency. Fertilizer moves efficiently. Energy flows efficiently. Parts move across borders smoothly. The system was created to maximize productivity. And you can't weaponize that integration without injuring yourself. It's like trying to punish your neighbor by setting fire to the shared wall of a duplex. Yes, smoke will fill their house, but it will fill yours first. Now let's connect this to the broader global pattern, because potash is a smaller preview of something much larger. The world is drifting toward resource nationalism, a period where countries treat critical inputs as strategic assets, not just for profit, but for power. We've seen it with energy, we've seen it with rare earths, we've seen it with semiconductors, and the potash episode hints at what happens when you enter that world without discipline. You start fights in sectors where you're exposed. You accidentally reveal where you're weak. You create volatility that rewards speculators and punishes citizens. And worst of all, you train everyone around you to stop trusting you as a stable anchor. That's not America first. That's America isolated. Now think about what structural power looks like in this new era. It's not always military. It's the quiet control over bottlenecks, the ability to restrict supply without firing a shot, the ability to create price shocks without a public announcement, the ability to force competitors into expensive reshoring efforts, the ability to make entire industries pay a risk premium just to function. Canada in potash holds that kind of power, and this episode showed Canada doesn't need to threaten to use it. The mere recognition of it in the market is enough. So where does that leave Americans, especially farmers? It leaves them caught between political performance and physical reality. Farmers can't vote their way out of potassium needs. Crops don't respond to ideology. A plant doesn't care who won the argument. A plant cares about nutrients, which means the biggest losers in these political theatrics are often the people who are most essential to the country, the producers. And the biggest winners are often the people farthest from real production, the volatility merchants. That's why this keeps happening, because the people who benefit from chaos are organized, sophisticated, and fast, and the people who pay are dispersed, exhausted, and slow to be compensated, if they're compensated at all. So here's the final takeaway. The potash crisis wasn't a show of dominance. It was a warning shot fired into America's own economic foundation. It proved that the US can be powerful and still be dependent. It proved that threats can backfire instantly in essential markets. It proved that in the modern world, control over inputs can matter more than control over narratives. And it forces the one question that matters in political economy. When leaders pick these fights, who benefits? Because it's not the farmer, it's not the consumer, it's not the family watching grocery bills climb. It's the people who know how to trade the fear. And until the public learns to see the system beneath the speeches, this cycle will repeat again and again, where politics manufactures conflict, markets price panic, speculators profit, and the productive economy bleeds. That's what really just happened. Not a trade war, a reveal of structural dependency, and a reminder that in the economy, gravity always wins.